Hey, this is Jim Musgrave, and welcome back to another episode of Retirement Insights. Now, if I asked you the question, hey, do you want to save taxes on your investments? I'd be willing to wager 100% of you would say, absolutely. And my follow-up question to you is, well, then what are you doing about it? See, there's probably a disconnect between wanting to save taxes and actually having a plan in place to save taxes. So in this episode, I'm going to share with you 5 strategies that you can apply today to ultimately reduce your taxes on your investments. Would that be something you'd be interested in? I hope so, because we're going to get right to it right now. Okay, the main thing you got to know right now is that guess what? The time clock is ticking. The Tax Cuts and Jobs Act, or the Trump tax cuts, will most likely sunset at the end of 2025, okay? That means that our taxes are going to go up. To be more specific, is that, let's say you are married filing jointly and you're in a 22% tax bracket. And let's just say that you make, let's say, I'm going to make it up, $160,000 a year as a married couple, and $160,000 puts you squarely in the 22% tax bracket, marginal tax bracket. But if the Tax Cuts and Jobs Act sunsets, that couple making $160,000 is now in the 28% tax bracket, okay? They just jumped from the 22 to 28. So what if you were in, let's say, if you made $250,000 as a married couple? Right now, you'd be in the 24% tax bracket. But if the Tax Cuts and Jobs Act expires, that $250,000 couple is now in the 33% tax bracket. That is huge. Not only that, we have standard deductions and personal exemptions may also change. Okay, so you need to have the mindset that, hey, listen, the risk of taxes going up is real. And the question is, what are you going to do about it? Okay, there's far too many of you that are doing nothing. You're just staying the course, putting money in the 401k, putting money in the savings, whatever you're doing. All you're thinking about is just putting the money in and the allocation, but you're not thinking about the tax consequences when you pull the money out. That is the secret sauce of what I'm talking about today. All right, so just understand that there's a very good chance that our taxes are going to go up when the Tax Cuts and Jobs Act expires at the end of 2025. Okay? All right. Now, my first tip for you is know how your accounts and the income is taxed. It starts right there. Okay? If you have what we call non-qualified money, money that went into, let's say, a brokerage account with after-tax dollars, that is a taxable account. Okay? When you get your 1099 tax statement at the end of the year, it's going to have 4 different types of taxes: short-term capital gains, long-term capital gains, dividends, and qualified dividends. Okay. Now, your long-term capital gains and your qualified dividends are typically taxed at a lower tax rate. In some cases, a 0% tax rate on long-term capital gains and dividends. Maybe you didn't know that. I'm going to cover that in just a second, okay? So know how your accounts are taxed. Long-term capital gains, qualified dividends are typically taxed at a lower tax bracket or tax rate than ordinary income. So your qualified accounts, again, it qualifies for current year tax deduction, your 401ks, IRAs, TSPs, 403Bs, 457 plans, your SEPs, your simple plans. Those are all pre-tax accounts where you got that current year tax deduction. But when you pull the money out, it comes out as taxable income at your ordinary income tax rate. Just understand that. And just remember, everybody's been told from day one that you're going to be in a lower tax bracket when you retire and get the current year tax deduction today. You're going to pull money out because you're going to be in a lower tax bracket. Guess what? If you want to maintain your standard of living, doesn't that mean you're going to be spending roughly about the same amount of money? And where's all the money going to come from when you want to satisfy or meet your retirement income needs? Well, for most people that I see, they've got at least 50% or more of all their portfolio in qualified accounts, which means that majority of that money that's coming out in retirement is going to be fully taxable. So how are you going to reduce your tax rate if most of the income that's going to come from to fund your lifestyle and retirement is going to be fully taxable? Think about it. Okay. Now, pensions are also taxed as ordinary income. Social Security is a more tax-efficient source of retirement income. Okay, up to 85% of Social Security is taxed. Again, I go deep into this in my Social Security seminars, which I encourage everybody to attend. But I go deep into how Social Security is taxed, and that's a whole different topic for another time. But we also have Roth IRAs, cash value life insurance, and also reverse mortgage or reverse mortgage lines of credit that are tax-free sources of income. Now, you may want to throw in muni bonds. I get it. That's cool. But I want you to think about how these different accounts you have the option to put your money in, how are they taxed, either as they accumulate and especially when you take the money out. So having that awareness will hopefully get you to think about the approach you're taking to constructing your allocation and where new money is going into as you're trying to build that nest egg. Okay, so first tip, know how accounts and income is taxed. Again, just send me an email and we're happy to provide some information to you if you'd like more information on this. Okay, number two, you can reduce taxes through asset location, right? You have the asset allocation, which is the percentage of stocks, bonds, stocks, bonds, cash, real estate, that kind of stuff. That's the allocation. But the location of where you own those assets is equally as important, okay? So in your non-qualified accounts, your taxable accounts, ideally, you want to avoid high turnover investment strategies, okay? Now, philosophically speaking, I like tactical management. You know, I kind of grew up on that. I get it. That's kind of my preferred style. However, that could be detrimental in taxable accounts because if you're constantly selling within 365 days, that's going to be a short-term capital gains. Okay, so there are pros and cons of tactical high turnover investment strategies in non-qualified accounts. Okay, now one thing we do all the time is that we'll put together portfolios using, let's say, dividend aristocrats, where we have individual stocks with qualified dividends, which are taxed at long-term capital gains rates. And for our higher net worth clients, we'll actually build muni bond portfolios. Like we can literally go to the trading desk and have them put together a laddered muni bond portfolio that generates income from the different coupons from the bonds, but all that income is tax-free, okay? So we're a big fan of qualified dividend stocks and also muni bonds. Now, you can also own muni bonds and ETFs and mutual funds, and there's certainly other ETFs and mutual funds that have more kind of dividend kind of stocks in there, and you can find them. So again, you don't have to own the individual stocks or bonds to do that. They are available in ETFs and mutual funds. Okay, dividend aristocrats. Okay, these have been around forever. These are the plain vanilla large cap value stocks, generally speaking. And the definition of a dividend aristocrat is that it's got to be a stock in the S&P 500 that has consistently raised their dividend for at least 25 years. Now, that is a huge challenge for any company to do. But when you look at that, there's maybe 60 or 70 dividend aristocrat stocks that are out there. And the idea is that you can build a portfolio of these stocks that have nice dividends that, yes, the value of the stocks will go up and down, but the dividends are fairly consistent, okay? And so that is another strategy. We like dividend aristocrats in non-qualified accounts. A biggie that all of you should be doing if you've got non-tax or taxable non-qualified accounts is tax loss harvesting. But all tax loss harvesting is capturing losses throughout the year to offset gains. And by that way, if you can offset the gains with some losses in your portfolio at the end of the day or at the end of the year, you will pay less in capital gains tax. So I'm going to talk about that in a lot more detail in just a second. Okay. The other thing another tool in the toolbox that a lot of people are not familiar with, and they should be, is cash value life insurance. Now, most of people that I know will have some term insurance, maybe some group life insurance through the company, and it's an inexpensive way to get death benefit. The idea is to, if I die, then I've got X amount of tax-free death benefit that goes to my beneficiaries. But when you're talking about term insurance or group life insurance, it's kind of like renting an apartment versus owning a house. Okay. With permanent life insurance, you actually have equity in your policy. So you have the cost of insurance that's always present inside a policy, but the premiums are higher than the cost of insurance. And that difference between the premiums and the cost of insurance and the internal expenses is what we call the cash value. And you can actually have access to that cash value. You can borrow against your policy. You're not borrowing money from your policy. You're borrowing money against your policy that you can pull money out to as a loan, maybe buy a car. And instead of paying the bank the car note, you basically pay yourself. You can pay yourself back. So cash value life insurance is a great tool in the toolbox for that money to grow tax-free. And again, there's all sorts of strategies that we'll have different kind of podcasts on that. But cash value life insurance can be a fantastic way to kind of grow money on a tax-free basis or tax-deferred basis, technically speaking. Okay, now, in terms of asset location, again, most people's portfolio are going to be in qualified accounts where you got a current year tax deduction, that money grows tax-deferred, and when you pull it out, it comes out fully taxable. And again, with Roth IRAs, that money went in after-tax dollars, and that money grows tax-free, and when you pull it out, it's tax-free as long as you follow the rules. Okay, now, in that case, it doesn't matter what you own in the traditional IRA or the Roth IRA because it's taxed the same regardless. Remember, in the non-qualified accounts, it could be short-term capital gains, which is taxed at ordinary income, or long-term capital gains, which could be anywhere between 0, 15, 20% currently. All right. So with qualified accounts, they're going to be taxed as they are, right? So it doesn't matter what you own in those types of accounts, okay? Now, it's a great place to own your high turnover investment strategies. If you're going to buy, I'll make it up, crypto or some kind of crazy thing like that. If you have things with great gains, ideally the place to put them is in your Roth, but still, it's a place that you can kind of kick that tax down the road. And again, just understand that if let's say you've got dividend aristocrat stocks, for example, or you've got high dividend stuff, those underlying securities might still be really good. But just understand is that all the gains and the dividends that might be reinvested, they're still going to be taxed as ordinary income when you pull that money out. So that's why we prefer to use the dividend stocks in the non-qualified accounts, because those gains actually are taxed at a lower rate. So that's a little bit about the asset location, which I think is something that far too many people do not take into consideration when constructing their portfolios. Okay, tax loss harvesting. I just briefly mentioned that before. This is a biggie that all of you should be doing if you got money in non-qualified accounts. And all it is that with tax loss harvesting, you've got gains and losses. The markets do not go in a straight line. They go up and down, right? And all the tax loss harvesting is trying to do is let's offset the gains with some losses. And if you can kind of neutral things out at the end of the year, you'll have a lower tax bill. It's kind of as simple as that. But let me kind of go into a little bit more detail on how that works. Now, again, just because the tax code allows you, yes, you can counterbalance the gains and the losses. But let's say you had a year where you had more than $3,000 of losses. Like let's say you had even like 2022 is a perfect example. 2008. 2001. These are years that we had losses, like big losses in the portfolio. Well, let's say you realized a bunch of losses. Well, you can only apply $3,000 of losses in any given year. Any losses beyond that will just be kind of pushed to the next year. Okay. Now, the way that the tax loss harvesting works is that, let's say you bought the S&P 500 and it was worth $10,000 when you bought it. Fine. I bought the S&P 500, $10,000 worth, and now 2022 comes around and the market drops 20%. And actually, it did drop 20% in 2022, roughly. All right. So you bought your S&P 500 at 10 grand. This year, it's down it is down 20%. Now it's worth $8,000. Okay. You've got a choice, right? You can do nothing and just wait for the share price to go back up, or you could use that loss to lower your tax bill. So what you do is that, let's say that $10,000 position in this example was one position of an entire diversified portfolio. Maybe we have some small cap, mid cap, some international, some bonds, some cash. So this $10,000 just represents a percentage of the overall portfolio. Well, what tax loss harvesting is doing is that if I sold, let's say, the BlackRock version of the S&P 500 with ticker IVV, I sold that at a loss, and then I bought the SPDR version SPY, which is the identical ETF. It's just owned by another company. And essentially what I've done is that I've kept my portfolio intact, but what I've done is that I have locked in that loss to offset future gains in that year, okay? And there can be some huge tax savings. So I had a conversation with a client about this recently, and she goes, I don't want to change. I don't want to sell anything because I don't want to lock in a loss. And the point I was trying to get across to her is that, hey, listen, the boats rise and fall with the tides, right? So if the market is down, it was the perfect time to actually lock in the losses, replace what was sold with something else that's very similar. So when the markets come back up, portfolio is intact, you lock in the loss, you just save some money in taxes. Sounds like a pretty good deal. Okay. So that's essentially what's happening with tax loss harvesting. And what we do with our clients is that we use institutional managers that have great models to begin with. And we also have tax efficient models. So the positions that we have in those portfolios are also more tax efficient. They may have a higher allocation of municipal bonds, for example. Okay. So we'll actually use tax efficient portfolios that are already tax efficient. And then we'll actually layer on professional, proactive tax loss harvesting on top of that. So throughout the year, when the market's going up and down, we're being proactive in our tax loss harvesting. And that what that ultimately does is that increases our rate of return. Why? Because your rate of return is not the rate of return on your statement. It's your rate of return minus the taxes you have to pay, right? So if you're making 10%, but you're paying, I'm going to make it up, 2% in taxes. Well, if we could reduce that to 1% in taxes or 0.5% in taxes, my net rate of return is higher. Okay. So what I want you to be thinking about is your rate of return net after tax. That's how you should be looking at rates of return, not before you take the money out and not before the taxes. In terms of capital gains rates, guess what? It's possible that you might have a 0% capital gains rate. What do you mean? Well, you can see right here, if you are single, and this is in 2024, if you're single, then if you make up to a little over $47,000, the capital gains rate for long-term capital gains is 0%. If you're between 47,000 and 518, then it's 15%. If you're married filing jointly and your taxes or your taxable income is a little over $94,000, you've got a 0% long-term capital gains rate. Okay. So, you need to be thinking about your income and where the money is. So if you are in retirement, that the typical distribution order is taxable accounts, then tax deferred, and then Roth. And one of the reasons that is that you're kicking down the tax deferred tax man down the road, but also when you're pulling money out of your non-qualified accounts, you might be in a lower tax bracket depending on what your income is, right? So that's another big way to ultimately, just understanding how investments are taxed on the way out can really save you lots and lots of money in taxes. Okay, now ultimately, the big conversation that I'm having is about Roth conversions. Okay, again, most people have the majority of their portfolio in pre-tax accounts. Okay, so by definition, what a Roth conversion is all you're doing is that I'm taking a distribution out of my IRA and I'm paying the tax, and then I'm going to put that after-tax account in some other investment. It could be in a brokerage account. It could be in, could be in a CD. You probably wouldn't want to do that. But the point is that you can own any investment in a Roth IRA. So visually speaking, this is what we call the personal economic model, where I can visually kind of show you how cash flow is. And in the PIM, we actually have the risk tank and we've got the safe tank. And all we're doing with a Roth conversion is that we're opening up the valve, we're draining out the tank, and it's got to go through the tax filter. So that's where you're going to be paying your federal tax and your state tax. And then what do you do with the money after that? Money after that can either go back into the safe tank, it can go back into the risk tank. It all depends on where you want that money to live. Now, one thing I will tell you from an administrative point of view is that if you're going to do a Roth conversion, you need to check the box Roth conversion versus a distribution. Because what happens is that the only difference between a Roth conversion and a distribution from your IRA is checking a box. Okay? If you check the box Roth conversion, that means that the after-tax dollars will live in a Roth IRA, which grows on a tax-free basis. But if you don't check the box Roth conversion, it's going to be considered a distribution. And the government's going to assume that money's just kind of growing in your taxable account, where you've got long and short-term capital gains on that. So if you're working with a professional like myself, we're going to make sure that's done correctly. But if you're doing things on your own, that's just a really critical point that you want to do. So I'm going to be talking more about Roth conversions in future episodes. This is a huge topic, but this is one of the things that that you really have to take into consideration, because I go back to the very beginning of what we talked about. If taxes go up, then do you want to take the risk of paying taxes at a higher tax bracket? Or would you like to eliminate that risk, pay the taxes today in a tax bracket that exists, and that way now you've eliminated the risk of paying taxes at a higher amount sometime in the future? So that's essentially what's going on with the Roth conversion. Again, I'm just kind of hitting the surface today, and we're going to go in a lot more detail and down the road. But this is a huge topic that I talk to everybody about. Okay, now, if you want more information on these taxes, I actually have a great brochure that has over a dozen different tax strategies, and I'm happy to give that to you. All you got to do is just go to my website, jimmusgrave.com/podcast, or when you go to the website up there on the little bar, just click on podcast. And all you got to do is just request the handouts. We're happy to do it. Just go on the website, say, hey, please send me the handouts for the episode 9 for the Tax Savvy Guidebook, and we'll get them to you. I also want to encourage you to hit like on the YouTube channel and also on my James C. Musgrave CRPC Facebook page. So I'm going to be posting a lot of great information on the Facebook page. Okay, so I hope you found this stuff valuable, and I really hope you start to think about how you approach your investments. And because it's not the rate of return that you make, it's the rate of return you make net after taxes. And how you pull that money out is important. And hopefully this was helpful to you to kind of take things at a different approach. So again, thank you so much for listening and watching, and I look forward to seeing you on the next episode. Take care.